Hello there, I'm Patrick Stroth, trusted authority in executive and transactional liability and president of Rubicon M&A Insurance Services. Now a proud member of Liberty Company Insurance Brokers, a nationwide network of specialized insurance brokerages. Welcome to M&A Masters, where I speak with the leading experts in mergers and acquisitions. And we're all about one thing here, that's a clean exit for owners, founders, and their investors. Today, I'm joined by Michael Kornman, managing partner of NCK Capital. Based in Dallas, NCK Capital acquires controlling interests in lower middle market companies and takes them to the next level with right fit capital structures, inspiring management incentives, and nurturing support. Michael, I'm really looking forward to this conversation today. Thank you for joining me.
Thanks for having me, Patrick.
So, Michael, before we get into NCK Capital and what you're doing, which I think is next level with transitions and so forth, which our audience is really going to enjoy, let's set the table and start with you. What brought you to this point in your career?
Yeah, so, my brother and I founded NCK Capital in 2014. And before that, we had built and run a number of lower middle market businesses in a few different industries. And so we felt we were well positioned to add value to the lower middle market companies, and also had a unique perspective where we walked in the shoes of a lot of founders. We've dealt with the same issues they've dealt with, and understand those on an intimate and very personal level. And so we thought we'd stop building companies from a dead stop and start investing in the lower middle market.
And now, as we transition to NCK Capital, I always like to find out about companies, how they're named, because NCK Capital is not necessarily your initials. So give us that background, then walk in and tell us about NCK Capital.
My last name is Kornman with a K, so everybody assumes that it's something Kornman, but that's not it at all. Grant and I have three daughters, Natalie, Claire, and Kate. And we were originally going to name the company oldest to youngest, so Claire, Kate, Natalie. We got the URL, we were building out the marketing materials, and it kept looking like Chicken Capital. And so we just couldn't deal with that. So we rearranged the letters, we got to NCK, and it's our daughters. Grant does have a son. He came after we founded the firm. He's still a beneficiary, so it's okay.
Well, yeah, we'll find something separate for him down the road. That'll be something. It's amazing. You are not the first guest to, share with us that getting the URL had a big role in how the name ultimately came out. So it's just one thing for the new age. Now, you're focusing on the lower middle market. You've been around for a little while here. So explain why lower middle market, what is it about that, and your thought process.
Yeah, we love the lower middle market. It's a great way. It's a great place to build value. There's so many lower middle market companies, and there's so much capital in the middle market that need folks like us to grow these companies to the scale that they need so that they can invest in them. And so we're generally the first institutional capital. Not always. And we have two portfolio companies that we acquired from other private equity firms. But generally, we focus on family or founder-owned businesses, and we love it because the market seems endless. And our story, we're a family. Grant and I built the firm. There's other people here now, but it really resonates with sellers, and so we've had good results.
Yeah, and I think that in addition to having the lower middle market, where it's a vast market out there, I think that's where you can really make big change, because so many owners and founders, they work hard, they're very successful, but they can only get their company to grow so far. And then they get to that inflection point where they're too big to be small, they're too small to be enterprise, and they don't know how to take that next step. And it gets scary because without organizations like NCK Capital out there, they may default and either go with a very large institution or a brand, or go to a strategic, which may not necessarily have their best interests in mind. And so the more options that are out there and the awareness that we can bring to the lower middle market is our way of serving this market, because if they don't know about this, they're at risk of being underserved and overcharged. And we can't do that to the owners and founders out there, because they're the backbone out here. A big distinguishing element of NCK Capital is that you do, and you mentioned this on your site, you target family-owned businesses as opposed to startups and so forth. Talk about that focus a little bit more. Why that's so personal? Is it just because you and your brother are family?
Yeah, we've walked in their shoes. We've dealt with the issues that small business owners deal with, and these are, I mean, make no bones about it, these are small businesses still. I mean, we invest in companies with 2 to 10 of EBITDA, and our sweet spot is really like 2 to 6. So these companies definitely are in the early stages of their life cycle, and we understand what it's like to have invested personal capital over a long period of time. We understand what it's like to build out an organization where you have real issues with people and challenges, and you've fought in the trenches alongside those people for a long time. We understand what it's like to build a culture and develop that culture, and how important that culture is to founders. And so we're user friendly. That's really important to us, and I think that's one of the reasons we've been successful.
One of the things I think is really exciting, because you're coming from an operating background, so you're not trying to kind of financially engineer these organizations, from maybe performance to great performance just by cutting expenses and moving around numbers. I think you got an operational tilt. I'm just curious, with some of the things that you've experienced, have you ever had the experience where you're sitting with the portfolio company, the management team, and they put their trust in you, and you talk about, well, we're going to try doing X, Y, and Z, and you just see this epiphany where they just look and they just like, I didn't expect that. Wow, we can do that. Did you have any kind of things? This is kind of off script, but those things happen.
It happens regularly, and it's really fun to see. I mean, so our focus at NCK is in addition to buy and build, which is obviously a common strategy in private equity, we really focus on companies where we can get organic growth, and we think that's really important. We like businesses with high EBITDA to cash flow conversion that we can grow organically. We like businesses that we can deploy, whether it's a digital marketing strategy or a more sophisticated sales and marketing strategy, or some of the more traditional people, process and technology and operations. We like businesses that we can grow in a way that a founder would understand, and so those conversations do happen, and it's fun to riff and collaborate with founders and sellers. And oftentimes, sellers are rolling over a substantial amount of equity, and that's an important part of our process, is educating them on kind of how we approach the world, what we're going to do post transaction, and explain to them kind of our excellent returns, and that helps us win deals as well.
Well, I think one of the scariest things out there for anybody, from personal experience, I'm getting emails constantly about marketing, lead list strategies, all these things. And I can imagine, if you're the owner and the founder, you're operating your business, you need to get sales up. You don't know how, and it's such a gamble. I mean, it can be very expensive. If you don't know what you're doing, it's really, really scary. So I think that your experience there on helping them bridge that gap on, opening marketing channels, sales, bringing in people, those are all the scariest things for owners and founders, because they have so much to risk, and you give them peace of mind because not only do you have the resources, you've got the experience, and you can just walk them through that.
I mean, some of these founders want to stay on and continue to run the business, but want to take a substantial amount of money off the table. And their analysis up to this point is, hey, I can grow this business, but it's going to reduce my distributions, and I'm going to have to go it alone. Where we come in and we're a team, so it's a a lot of fun to collaborate with these folks, and the leverage you get is huge.
Well, now I'm going to go back to something we talked about at the very beginning about there are a couple of elements that distinguish what NCK Capital does. Again, as a Californian, it's like the softer approach with business, but you were doing a couple of things here. If you could just give us a sentence or two, just how do you mean it? And we'll start with right-sized capital structures.
Yeah, I mean that's a really great question. In the lower middle market, these small in the lower end of the lower middle market, when you start to grow these businesses, there's definitely a J curve. There's definitely a dip in EBITDA, and so you just have to make sure that you're planning for that, because if you and generally it's through over equitizing the business. But if you use debt or the wrong kind of debt or too much debt, rather, we all use debt, but it can really be painful and disruptive in the early part of the investment period. So we just like to make sure that we're set up for success, and there may be a period where things are a little less smooth than you'd like. I mean, generally, the inflection point in our experience is 2 years. The first 2 years, you're investing, you're growing. And, it really takes about 18 months to 2 years for the EBITDA to really EBITDA growth to materialize.
And that's the term that a lot of people tie in with family offices. They call that patient capital. But, if you know that out front, that you've got this time window, don't panic. Let's just go through it. And I mean, at our age now, 18 months goes by really quick. You're going to get to the other side. So you bring that on. I think that's very helpful because it also brings the temperature down, especially following, the closing. I'm sure management, as they roll over, they want to hit the ground running, and they're very, stressed. They want to make a good impression. Relax. You walk that. So that's a great way to ensure success. The other thing you mentioned is not just management incentives, but inspiring management incentives. So talk about that a little bit.
Yeah, so a lot of times we're recruiting managers from outside the business, and that's where you experience a lot of growth, just hiring fantastic people that some of these businesses just haven't had exposure to people of this quality and sophistication before, and so our focus is we really view those management teams as partners, and I know a lot of people say that. We're really focused on wealth creation for them. And that is, we want to make sure that they're focused on the long run. They're focused on, ultimately the exit. And, we get really excited when our management team partners build considerable amounts of wealth in these deals.
Kind of fun when you watch that. It ensures just everybody's interests are aligned, and why wouldn't that be? Because I'm personally have an abundance mindset, so if that's being passed out, that just only inures to the benefit of all, which is fantastic, and it also speaks to a track record for future investments down the road. And I think that is just credibility that can't be questioned. The final thing you talk about, and again, as Californians, we look at this, we've talked about nurturing and culture and things, which there are a lot of people that look at that sideways maybe 5-10 years ago. But then the book Infinite Game came out with Simon Sinek, and you're seeing a change in mindset with management looking at things like culture, where they're like grading it, they are measuring it, and so forth. Let's talk about what you do when you're talking about nurturing.
Yeah, well, the first thing we do when you talk about culture, well, we provide a lot of support to our management companies. To our management teams. I've never walked into a company where people were sitting idle and they had a lot of extra capacity. But they're dealing with day-to-day issues running a business, and we all agree as a team that there are certain initiatives that can add a lot of value that may require outside resources. It may be us at NCK Capital, it may be the right consultant, but it could be something like sourcing the right vendor for a digital marketing initiative. It could be selecting a new site for, a new location, geographic expansion. It could be really anything that an executive team member would do that they may not have capacity to do. So we'll parachute in, we'll work alongside the management teams and get those high value initiatives completed. But we also, back to the culture discussion, we really believe it's important to understand the culture of the business and understand the people. And no matter how much diligence you do, it's really hard to understand that completely pre-acquisition. So when it comes to culture, which we think is an incredible accelerant for value creation and growth, we take I wouldn't say a passive approach, but a more patient approach in stepping back and observing and learning. And that's just, I think there's a lot of, everybody's pressured to move fast in this business. I think that's one place where you just can't move that quickly.
Yeah, I think that's, everybody mistakes culture for, well, we've got a very formal dress code, attitude versus, relaxed dress code. No, it's how you do things. There are some organizations that are comfortable just, putting as much, throwing as much on the wall as possible, see what sticks. There are others that want to go step by step on a process, and you've got to get that kind of synced up, and you do this. And I'm remiss. Are there particular industries that you target?
Yeah, so we really like services businesses, and that could be any service that provides an essential service to another, any business that provides an essential service to another business. Could be a tech-enabled service. It could be an environmental service company. It could be we have a building services company in our portfolio. Really, we like healthcare services of certain types. We really like all sorts of service businesses. We also it's a little bit different and not in everybody's investment criteria is we really like for-profit education. We have we just exited one. We had 2 vocational schools in our portfolio, and really like education businesses of all types, not just schools. Specialty distribution businesses, we're working on one now. And then niche manufacturing, where those are our 4 buckets.
Okay, fantastic. When we talk about mergers and acquisitions in the lower middle market, we're dealing with, 2 parties. We got one party that's experienced, that's almost always the buyer, and then the less experienced is the seller, where they don't sell their business every day. This is usually their one time. And when you have situations where you have a deficit of experience, fear and distrust can come in, where one side saying we're going to do X, Y, and Z, and this is market, this is how it works, and then the unfamiliar side is just like, wait a minute, I didn't see this coming. And so there's always a real danger for these deals happening, as they look good on paper, but when you're dealing with people, okay, we've got those elements of fear and greed out there, and you can't get around that. And so as you go through the myriad of the process with due diligence and everything else, that all these things can sidetrack a deal, and sometimes it comes down to the people. What we're very proud about in the insurance industry is we found ways, because with fear, it's fear of risk and fear of loss of money and so forth. And what's been nice is the insurance industry has come in with an insurance product called reps and warranties insurance. The buyer suffers a financial loss as a result of a breach of the seller reps. Now, the seller is looking at this saying, wait, I've disclosed everything to you. You've done diligence. If I didn't know it, I didn't know it. And the buyer says, I'm sorry, this is market. We have to do this. We have to, put this little backstop on. It's what everybody does. And we just have to do this, go forward. And so there's an element of distrust. Well, if you've got a rep and warranty policy in, all of a sudden, an insurance policy takes the place of the seller's indemnity obligation. Seller gets a clean exit. If the buyer suffers a loss, buyer's made whole. And so it's just been a real revolutionary product that's accelerated deals getting closed successfully. It's lowered the temperature. It's done a lot of wonderful things. But, don't take my word for it. Michael, good, bad, or indifferent, what experience have you had with rep and warranty insurance?
I mean, it's the greatest thing since sliced bread, right? I mean, we just exited one of our portfolio companies. It's a reps and warranties policy there. It, of course, reduce the escrow, maximize proceeds to the seller. It made negotiation of the purchase agreement considerably easier. And, we're excited being in the lower middle market that's now available. It obviously started in the middle market and is a tool that is available to us in the lower middle market. And we use it everywhere we can.
Well, I'm very pleased because, especially for the lower middle market, there's been a little bit of a threshold because while rep and warranty does come down to smaller deals, there's a point at which the cost for due diligence to be eligible becomes a barrier to entry. And this is largely on deals where the transaction value starts falling below 20 million. A lot of buyers do not want to incur the expense to do all the diligence to get there. And at this time in 2021, the insurance industry is so full with the larger deals, there's absolutely no bandwidth to even entertain small deals. What I'm very excited about is that there is a new facility out there. It provides a sell side policy, but it's one where it's designed exclusively for micro market deals where the transaction value goes from under $1 million to 10 million, where the policy can insure that deal all the way to full transaction value up to 10 million. There is no underwriting fee. There's no diligence process required. It's just an application. And it's designed to address that area. And, we're using this as a platform to get the word out because even though a lot of lower middle market deals are involving companies larger than 10 million, you always have add-ons. And it's really nice if you can backstop, a sub $10 million add-on where the seller has a policy at the seller's expense so the buyer has some protection. And so it's called TLPE. So I want to make sure that we just make a mention of that because for NCK Capital, as they go on, this could be a fit on some areas where the traditional rep and warranty policy just doesn't work.
Sounds like a fantastic tool to have in the toolbox, especially for add-ons. So that can make those a lot easier.
Yeah, thanks a lot. Thanks a lot for your comments on this. I'm glad that you got that one deal done. It's interesting. We're kind of curious with private equity. The view of private equity is they are very reluctant to incur insurance premium expenses. If they can transfer risk, however they can limit their expenditures, they won't hesitate. Rep and warranty is the one exception where they gladly go. And I'm very proud because it's been the good performance by the insurance companies. They've kept their word. They've delivered on claims. And so we're very, very happy. But as we get back into, NCK Capital, Michael, I blinked and we're already planning for 2022. Could you share with us what trends do you see as we go end of 2021 into 2022, either macro or NCK Capital in particular?
Sentiment is mixed. Some people think that there's going to be reduced deal volume in 2022, and some of the proposed tax changes were driving or anticipated tax changes were driving 2021. Deal volumes, obviously 2021 was incredibly busy for everyone. I'm a little more optimistic. I think there's a lot of businesses that are waited to come to market due to they wanted to get some time away from the pandemic, and I think there's going to be an enormous number of great businesses in the marketplace. One of the things that I think that we've seen just from a deal structure standpoint is there's been more structure in deals this year than earnouts were dead pre-pandemic. They just weren't very commonly used, and you're starting to see those more and more, and I think that's really interesting. So I think that's going to be. I think that trend may continue on into 2022 as well.
I agree. I see no end in sight with M&A, and I think that we're just going to get a lot more creative as we go forward. And I think that taxes are going to go where taxes are going to go. That should never be your primary motivator for doing things. I also agree there have been a lot of sellers that have been on the sideline because they're kind of refilling their balance sheets and just upping their value as they go along. Well, Michael Kornman with NCK Capital, how can our audience members find you?
Yeah, thank you for asking. Our website is nckcapital.com. You can find both Grant and I there. Really a pleasure to chat with you today, Patrick. It's a great podcast. I listen to it regularly, and I was honored that you invited me on. So thank you very much.
Thank you so much. And I will just, as a shameless plug for NCK Capital, I would say to him, we've got quite a few audience members out there that are family-owned businesses, that are owners and founders out there. Give NCK Capital a quick look, especially because I think they've got a soft spot for you, and that always works to everybody's benefit. So, Michael, thank you again.
Thank you so much.